I'm Andrew Byrne from NMP, and you are watching Beyond Print. With us today, we have the legendary David H. Stevens. David, thank you for joining us.
Great to be here.
So listen, I want to talk to you. You wrote an article, for NMP. It's the Piecemeal GSE Reform is risky. Want to talk to you about that. It's a great article. Got some great actually feedback from our readers on that. But let's so if people haven't read the article, one of the things you talk about actually how the administration came up in September, with a more comprehensive approach to GSE reform. Talk to us a little bit about that plan that came out. I think it was like early September.
Yeah, so the administration came out with two papers, one about HUD and one about done by Treasury about the GSEs. Let's just focus on the GSE side for a moment. Sure. But the plan called for both steps being taken by Congress and steps being taken administratively. And look, we all know the challenges of getting anything done in Congress right now. It's very political, and there couldn't be more polar opposing issues than we've ever seen in many of our lives. But the reality is that what they called for in their paper was largely applauded by many, including myself. The MBA obviously applauded it because it called for Congress to establish a explicit guarantee behind the mortgage-backed securities. It called for changing the charters to allow for multiple guarantors, which could bring more competition and eliminate what we call too big to fail, some of the risk that may actually be applied now if they go purely administratively, simply because if institutions are too big to fail, they're applied SIFI standards for capital, and that could actually raise costs for mortgages. And there was a basic understanding and belief by many stakeholders, including the MBA, which has been reiterated recently in a piece that Bob Brooksmith put out, that the duopoly has some characteristics to it that may not necessarily help keep a level playing field for all lenders to compete in the marketplace, and may ultimately expose us to more risk downstream. So paper was great. The challenge is that in the absence of legislation, Director Calabria has made a commitment. He's going to move forward administratively with or without legislation, and you're seeing it in his speeches and his comments and his interviews, that he's moving, straight forward towards recapitalization of these companies, and some form of release, whether it's next year or post-election, is yet to be determined. In my view, simply recap and release could create some risk, particularly for what I'm concerned about most, which is access to the secondary market by all lenders, large and small, bank and non-bank, on a level playing field where pricing and credit terms are not used to buy market share. And those aren't necessarily going to be locked in, and maybe can't be locked in without legislation to do that.
Got it. So you talked about actually that we have an election coming up. Is this something that gets pushed off till after election? I mean, is this like is this a potential landmine or opportunity, for election year?
I can't read the minds of those in the administration, but I will say this, having worked in an administration, I think the view would be most likely that they do the building blocks next year and move towards execution perhaps in the year following the election. That being said, if President Trump is not reelected, that may put some pressure, particularly on Director Calabria, to do things administratively as quickly as possible before a new regime comes in with a different approach. They've already made one change, right? They modified the PSPA to allow for greater retention of capital. Not a ton, but it was a change. So there are some things that are already happening here towards reform. But the big building block items to do recap and release, which is going to be extremely challenging for the markets broadly, my own sense is they would prefer to wait. Will they rush to get something done should President Trump lose? That's yet to be determined. I think that would be unfortunate if that were the case, because this is far too complex to rush through just simply to get to the goal line without having the pieces in place.
So this is going to sound a little weird, but David, so you've had experience at FHA. You've worked actually at top mortgage lenders, and you've advocated for lenders through the MBA. You have actually like a resume that has actually the makings of someone who could come up with the perfect plan. We're talking about comments about other people's plans they put together. If you actually, if this was your plan, if someone said, all right, David, we don't know what to do here, give us your feedback. What do you think we should do? What would GSE reform look like in your mind?
There was an interesting piece that came out from the Bloomberg editorial board recently that challenged, similar to my piece, which said, things are actually working pretty well in conservatorship. Don't shoot me. This may be blasphemy to many, but the things are working pretty well in conservatorship. So before you screw this up, that's not how it was written, make sure you've got a better solution in place.
Yeah.
There were two papers that with models that I could have supported for different reasons. One was the paper the MBA came out with, which they still stand by, which is a multi-guarantor model with an explicit guarantee on the mortgage-backed securities, limited use of the portfolios, a legislated level playing field with level pricing and credit terms for all lenders. And that functionally could have worked. There were questions about whether new entrants would actually come into the market. It has its problems, but it was a model that I was proud to be able to represent it when I ran the MBA. There was another model written by Jim Parrott, who's a former member of the National Economic Council in the White House, and the well-known economist Mark Zandi from Moody's. They produced a paper which called for a single utility model, in essence merging Fannie and Freddie or creating one entity out of the two, because they believe that the pure nature of competition and shareholder-owned private entities with a government guarantee would ultimately lead to adverse selection, because the pursuit of profits for shareholders at some point was going to work against the best interests of the taxpayer and perhaps the housing market. I saw strengths in both. The one has competition, private market participation.
Yeah.
That model could work. The other is this single utility model. Honestly, single government corp, I think that could work as well. My own sense is this is one where you can't strive for perfection because there's going to be too many disparate views. But at minimum, there are things we do need to lock in. I talked about it in my paper, but making sure that we have the structure in place before simply running to recap and release of these guys, I think should be the top priority for any stakeholder in the housing market. And for a lot of folks who read your stuff, small lenders, community banks, independent mortgage bankers, small credit unions, they're the ones at greatest risk. Everybody has agreed with me that the beneficiaries of any scale back or contraction of Freddie and Fannie will be big balance sheet institutions like the large banks, because they can hold assets where most everybody else needs an exit into the marketplace. Honestly, to protect consumers, to make sure there's good competition in the marketplace and keep a robust, diversified, competitive industry, this is what we ought to be making sure when Mark Calabria takes the next steps, that we can endorse that and not just simply roll over and let that happen without us raising our voice.
Right. So you talked about actually, about potentially screwing this all up. Well, what is that worst case scenario? So let's say we do the ready, fire, aim approach, as you called it in the article, and it doesn't work out. And what to describe to us actually, what you see being actually, a worst case scenario, just so we have that doomsday picture.
Yeah. Well, first of all, I've known the director for many, many years, long before this job, and he's a smart guy, and he certainly can understand economic implications, et cetera. He has traditionally been opposed to the size and scope of the role the federal government plays in the housing market. So that would lead to it support things that we've heard him say that sound like a desire to scale back the size and scope of Freddie and Fannie, whether it's holding them back from going too deep into affordable lending, or questioning how high these high-cost loan limits should be, particularly in those key urban markets on the coasts that have those, and establishing maybe a significantly increased minimum capital standard, which would simply put more cost into the program, thus making execution to bank portfolios and some of the new securitization models more competitive. So that all is actually good as an objective. The challenge here, I think we all need to remember, is, and I remember I ran the single family business at Freddie Mac for better part of a decade. And I saw what happened when we were being pressured, both when the private market started growing and the GSEs ended up getting into buying Alt-A and the AAAs on subprime and holding them in portfolio. Fannie Mae securitized a lot of Countrywide's pay option arm product in a separate private label securitization, but it was wrapped by the GSEs. The GSEs can either be hugely supportive and critical components of the market without risk, or under undue pressure, they can create risk unto themselves. And that's what I worry about. So worst case outcome, we rush to recapitalization and release under a timeline without having all the supports in place. And on top of it, the director tries to contract the footprint a bit in areas that we've talked about before, whether it's cash out refinancing or investor properties or loan size for particularly the high cost jumbo markets or capital standards and more. There is a risk you get contraction combined with recapitalization and release. Any contraction right now, and I'll shut up in a second, but as you all know, pre-recession, there was a robust private label market. Now, it got out of hand.
Yeah.
But the private label market, there were other pathways for lenders to sell their loans to. Today, the entire U.S. housing system is dependent on Fannie, Freddie, and the Ginnie Mae programs, other than what's in the jumbo space and some marginal growth that's occurring in the non-QM space. But that is de minimis compared to this dependency on the government-supported programs. So before we start pulling legs of the stool away, there has to be a discussion about what's going to replace those legs, and do we suddenly create an imbalance that makes all these community lenders across the country that have served the market so well suddenly uncompetitive or unable to offer product, and having product only available by a handful of large, extremely well capitalized depositories. I think that's a real risk. To me, that's kind of the worst outcome, which is moving too fast before we have figured out what the model is going to look like and what the counter supports are going to be in place. And that's why the legislative reform steps that the Treasury's own paper calls for shouldn't be separated, in my view. I think that there should be at least a sincere effort by Treasury to try to get a legislative measure started in the Senate Banking Committee under Chairman Crapo and the House Financial Services Committee under Chairman Waters, and just see if that can happen. And we just cut a trade deal and Congress signed off on it. These kinds of things that aren't political as much can sometimes be worked on, actually may cool the tempers up on Capitol Hill. I would support the Treasury Secretary and the President calling on Congress to try to do something legislatively here, so we just don't make a mess out of the one part of our economy that's working so well, which is the housing market.
Yeah. So, so one of the things you talked about actually the risk that the GSE started taking when they started taking on some of the option arm loans and the other private label securities. So do you see actually that we almost have like a similar situation with the GSE with the QM patch in place? I mean, do you feel like that some of the loans that fall into the QM patch space, are a little riskier than what the GSEs should be involved in?
Well, this is a great which comes first, chicken or the egg question. But I would say this to your point. Yeah, there's more risk. We know that, right? The QM rule, as it's written by the CFPB with the Appendix Q and the hardline 43% debt to income ratio, would contract the available product set that's currently offered in the QM space by the GSEs by estimates somewhere between 15 and 20%. That's significant. So it tells you that the patch has created an expanded credit set that the rule itself doesn't cover. So I have advocated for a long time, and I think there are many others signing on board to this today, that in my view, the patch should be eliminated. The rule should stand on its own, because when you have a patch that gives an exception to Freddie and Fannie and everybody else has to comply with a tighter credit standard, all you're doing is guaranteeing Freddie and Fannie are going to get bigger. If you want balance in the system, at least make sure you're not creating an unusual bubble for the government-backed programs have competitive advantages over the private market. But the rule itself needs to be rewritten. And a lot of people are advocating for that. Whoever came up with this 43% hardline debt to income ratio has never been a mortgage underwriter, right? We all know 43 can be too high for some, too low for others. A lot depends on your excess reserves after you make your fixed payments every month. You're experienced in making payments that are higher DTI impacts to you, and a variety of other factors that go into underwriting a loan. It's nuanced. And so, in my view, the Bureau should find a way to eliminate the debt to income ratio, come up with a way that still provides safety and soundness for consumers, require lenders to prove ability to repay, but let's get rid of the regulator writing underwriting guidelines, because that's a really difficult thing for something like the CFPB to be able to do.
Yeah. Makes sense. So listen, David, I always appreciate you taking the time today. Thank you for the article. Looking forward to continued dialogue, as we get closer to a potential solution. And as always, we appreciate you taking the time today.
Great to be here anytime.
And